Welcome back to The Explainer. Today, we are analyzing the massive multi-front assault that has completely battered the cryptocurrency markets this week. If you've been watching the charts and wondering why the sea of green we enjoyed earlier this year has suddenly turned crimson, well, you are in exactly the right place. We're going to break down the specific economic forces, the institutional shifts, and the changing narratives that are all crashing together right now to create this epic convergence. Okay, let's jump right into the action. Minus 13%. That is Bitcoin wrapping up its absolute worst week since February. For an asset class that literally thrives on momentum, a sudden double-digit weekly drop of this magnitude forces us to step back and ask, is this just your run-of-the-mill pullback, or are we looking at the start of a much larger systemic shift in the market? And, this rapid decline wasn't some quiet, orderly sell-off either. The sheer speed of the drop triggered a devastating $1.6 billion in market-wide liquidations in just 24 hours. That tells us a massive amount of leveraged long positions, basically traders heavily betting the price would just keep climbing, were caught completely off guard, forcibly wiped out, and that just accelerated the downward spiral. So let's look at our first major battleground, the 60K support siege, marking Bitcoin's worst week since February. Bitcoin briefly dipped below 60,000 today, intensely testing that absolute bottom line of defense. And man, while Bitcoin was struggling just to hold its ground, major altcoins faced an absolute massacre. Cardano, for instance, collapsed down to its lowest level since 2020, and Ethereum slipped down towards $1,740. Make no mistake, this wasn't just a Bitcoin problem. This was a brutal sector-wide capitulation. And that vividly illustrates the extreme bearish sentiment currently circulating. With the whole buy and hold narrative taking serious damage, popular analysts are actually warning that this drop could be a catastrophic blow. It could shake the conviction of even long-term survivors and potentially trigger a much deeper slide toward the $50,000 to $54,000 range. Which brings us to our next chapter, the macro headwind. Or, as it feels right now, the final boss, the Fed. To understand why this is happening, we have to look over at the traditional economy. The U.S. economy added a jaw-dropping 172,000 jobs in May. That completely shattered the 88,000 estimate. And this wasn't a one-off anomaly. It marked a third consecutive massive jobs beat. The labor market is just running significantly hotter than anyone anticipated. So the absolutely crucial point here is how fast the narrative shifted because of that data. Back in early 2026, the entire market was pricing in interest rate cuts, which are historically fantastic for risk assets like Bitcoin. But a resilient, red-hot labor market means the Fed is now openly pivoting. By June, FOMC members are explicitly discussing the potential of raising rates instead of cutting them, just to cool off inflation. This hawkish shift has an immediate, heavy impact on crypto. By pushing back the timeline for rate cuts, the opportunity cost of holding a non-yielding asset like Bitcoin absolutely skyrockets. It strengthens the US dollar and treasuries, basically acting like a giant vacuum, draining liquidity straight out of the highly speculative crypto ecosystem. Let's move on to Section 3, the Great Rotation and AI's capital vacuum. You have to notice these stark contrasts taking place right now. Investors are aggressively rotating their capital away from crypto and funneling it straight into artificial intelligence stocks and upcoming mega-cap IPOs like SpaceX officially starting its roadshow. AI is acting like a super-powered rival right now, completely overpowering the appeal of digital assets as the dominant momentum trade. Furthermore, even within the crypto space itself, the landscape is totally shifting. Investors aren't just fleeing to AI. The money that is staying within the crypto ecosystem is largely retreating from speculative bets and moving toward the safety and utility of stablecoin settlement. The pure momentum trade for crypto is definitely hitting the pause button. Which leads us to Section 4, the institutional betrayal, breaking the never sell rule. The outflows we're seeing are honestly staggering. Bitcoin ETFs have hemorrhaged a record-breaking $25 billion over 13 consecutive days of capital outflows since mid-May. That institutional bid that drove the market up so high earlier this year, it's aggressively unwinding. But perhaps the biggest hit to market morale was this headline. MicroStrategy, led by Michael Saylor, actually disclosed its first Bitcoin sale in 4 years, liquidating 32 Bitcoin. Now, logically, 32 Bitcoin is a microscopic fraction of their $56 billion portfolio. But markets run on sentiment, right? Breaking their famous buy and hold forever narrative deeply spooked investors and pretty much shattered the momentum. But it's not all doom and gloom. Let's jump to Section 5, the underdog's secret weapon, moving from vibes to fundamentals. It is crystal clear the market is undergoing a painful but necessary metamorphosis. The old era was a momentum trade, surfing entirely on market vibes and easy liquidity. But the new era we are entering, it's a serious contrarian bet that demands patience, real-world utility, and incredibly strong fundamentals. The market consensus right now perfectly captures this shift. With AI and hawkish Fed policies sucking all the oxygen out of the room, investors are increasingly favoring fundamental value over just vibes, meaning the only assets withstanding this slide are the ones actually proving they do something valuable. Just look at these idiosyncratic surges standing out in a sea of red. While the broader market crashed, Near Protocol actually hit a record total value locked. BTW surged over 245% following a Binance futures listing, and OPN rose 23% based on actual real-world World Cup-related contract demand. These projects are actively defying the crash because they offer clear fundamental value and real catalysts. And helping build that fundamental foundation is the SEC's newly released Draft Strategic Plan for 2026 through 2030. It officially targets digital assets and distributed ledger technologies, aiming to provide a clear and practical regulatory framework. This signals a much-needed shift toward rational regulation, which really strengthens long-term institutional hopes. Which brings us right into our final section, the cliffhanger. What exactly happens next? Well, the technical structure is incredibly fragile right now. If Bitcoin fails to hold that critical $60,000 support line, popular prediction markets and analysts forecast a much deeper slide toward the $50,000 to $54,000 range. However, because short positions are stacking up so rapidly, any positive economic news could trigger a massive short covering rally, basically forcing those betting against Bitcoin to buy it back. And that could send the price rocketing right back towards 70,000. And that leaves us with the ultimate cliffhanger for today's explainer, the 60K question. Are we looking at a classic bull trap designed to catch overly eager buyers, or is the market setting up the perfect generational opportunity to buy the dip before the next epic leg up? Watch the data, watch the Fed, and most importantly, keep your eyes on the fundamentals. Thanks so much for joining me on this explainer, and I will see you next time.